Hello, and in this video I'd like to talk about budgeting. This is the chapter 6 of Jerry Zimmerman's book. Um, so Jerry kind of nicely summarizes for us budgeting concepts. I'd like to bring it a little bit more to life for you. So here's some quotes from the text. Budget is a management's formal quantification of operations for future period. It's an aggregate forecast of all transactions expected to occur. So what does this really mean, formal quantification of the operations for future period? In other words, it's essentially a plan expressed in numbers of whether the organization wants to be in some period of time. It might be next month, it might be in 3 months, it might be in 3 years, it might be in 1 year, depending on where, what the purpose of the budget is. That's what we'll talk about. So fundamentally, it's about trying to take goals of the organization, strategic goals of the organization, whether short-term or long-term, and quantify them in essentially projected financial statements of some fashion. They don't have to follow necessarily the GAAP format, but typically they correspond somewhat to that, and they're pretty close in their presentation. And then, once you have that plan, this budget, which is a quantifiable plan essentially, it's used for control purposes. You can compare your actual performance to your budgeted performance, which is another way of saying, that's where we wanted to be, and that's where we ended up. And if we ended up, if we exceeded our numbers, why? If we did better than we expected, why? And if we did worse than they expected, why? What were the reasons? What was it? Something wrong with the plan? Was it something wrong with the performance? So it's kind of, I think the very first thing to understand and to take a step back, it's just budget is fundamentally a strategic tool. It's a strategic planning tool. And we do it, explicitly or implicitly, all of us do it, right? Financially, I don't know if any one of you sits down and formalizes a budget for your household. We don't do that formally, but informally we'll do it in our head. We kind of know, okay, this is the money coming in, this is the money coming out. That's where we want to be in terms of our savings. That's what our goals are. That's how much money we got to bring in order to meet our spending needs. And that's a budget. Whether you define it, formally or not, it's a different matter. But we all are, in one fashion or the other, engaged in a informal or formal process of doing that. Now, even more so, this process becomes important formally in the large, complex organizations. And when I mean large, complex, I don't mean hundreds of thousands of people. I used to be a treasurer, meaning a volunteer accountant, essentially, or you can, if you want to glorify that a little bit more, volunteer CFO of a small religious nonprofit, in the late 1990s. And that was an organization where their annual budget was roughly, let's say $150,000. And, one of the things that I did when and I was still in college when I did that, is I essentially brought in the notion of budgeting and projecting cash flows when I became the treasurer. And this organization, as many religious organizations are, that are small, was perennially in the need of money. They never had the money. They were always in some sort of a financial crunch. And one of the things that I did is that as a member of the board, I started bringing in Excel projections and Excel spreadsheets to the board. And, suddenly they realized that what they were doing essentially could bankrupt the organization in a long period of time. They didn't live according to their means. Now, one could ask a question, would they why couldn't they have done that otherwise? Why didn't they see it? Why was there a need for me to bring this information to them? It wasn't that blatantly obvious. And one of the things that I think, one of the lessons that you learn from that experience that I think is applicable to any organization is that, what we learned from the previous chapter when Jerry talks about organizations being fundamentally these decentralized institutions where everybody kind of fundamentally acts in their own interests, and any organization has the fundamental problem of aligning interests of individuals, the employees, the owners, the contractors, whatever, with the goals of the organization. And it's very difficult to do because we're all very busy people. We all kind of do our own thing. We don't communicate well. Think about this in the context of a nonprofit, a small religious nonprofit, where people are all volunteers. This is not like the main thing to them. The organization has 2 employees: the clergy and the part-time bookkeeper. So they don't have incentives to monitor anything, really. I mean, that's too complex. They kind of do this out of the goodness of their hearts. And what the budgeting process brought to them, budgeting, forecasting, reporting process brought to them, is in simplified, succinct terms. It tells them a financial picture of the organization now and where it will end up under different scenarios, right? And so, for example, one of the lessons that we learned in that process is that they were burning through a lot of money. We're living according to not according to our means. So immediately it also became clear, well, how much more money do we need to raise in order to get us out of the red into the black, right, so to speak. So essentially the purpose of budgeting, even though it's fundamentally a hypothetical exercise, and some people say, well, it's just, why you engaged in this guessing. What it does is it formalizes your intentions. It allows people to communicate information, within the organization much better. What Jerry likes to point out, it allows to disseminate knowledge, right? That he uses that term, but in more simplified terms, what it means is that it communicates information better to many different people and aggregates information across different people so that it levels information playing field in the organization much better. So we're all aware of everybody kind of knows now everything, as opposed to one party knowing one piece, another party knowing another piece, and the result is there's a problem in the bad decision making. So in many ways, it corresponds very well to what President Eisenhower's quote that Jerry Zimmerman brings up: "Plans are useless, but planning is indispensable." I don't think plans are entirely useless, but I think what this quote emphasizes is that the process of budgeting is much more important than the final numbers. The final numbers themselves don't, they're more of a control device, right? Budget versus actual, that's what we're planned to be, that's where we'll end up, and then trying to understand later on. So, the budget is just based on the same principles and ideas. Developing the budget, as we saw in the forecasting, you need information about expected product prices, expected sales. If you're an organization operating in foreign markets and collecting or making money or making payments in foreign currency, well, you need to then take into account expected foreign currency exchange rates, obviously prices of key inputs. So if you go back to the spreadsheet, and when we were looking at our forecasting exercise in the first part of the class, this is a primitive budget here, right? I'm assuming essentially that I have one product, in this case is wine or whatever, spirits. I've assumed some prices here. I budgeted expected demand. Then from prices and quantities, I can now forecast the revenues. I've made various assumptions about gross margins, about the level of other types of expenses. So this is essentially the same process that we already learned. Now, I think when you discuss budgeting and different types of budgeting, the focus is less on the spreadsheet. The focus is more on the source of information and where this is coming from. So, when you go back to the what Zimmerman talks about, it's an aggregate forecast of all transactions expected to occur. Well, in a real organization, this is one product. In a real organization, you're going to have multiple products. You're going to have multiple sources of demand. It's going to be much more complex. No organization sells one thing, typically, unless you're like an oil company or something like that. But even there are different types of oil and so on. So you need to suddenly you can think about you have multiple product lines, multiple locations, all of those inputs that we see here on one spreadsheet. You have multiple spreadsheets like this, and they all somehow are aggregated into a single financial statement. And so you can think about a situation where multiple people. So when Zimmerman talks about accumulated knowledge across different organizational units, organizational parties, he's essentially thinking, you can think of it and visualize it, or if you will, formalize it in your head as thousands of spreadsheets like this existing in a multinational company. They're all somehow, different people have different unique knowledge about these numbers here, about what the average prices are going to be. What are they reasonable? What prices are reasonable? What the average demand is going to be? What the expected demand is going to be? What's going to happen to foreign exchange rates? And they all somehow communicate this information to management, and then it's all aggregated into this one final budget. And the budgets are, of course, the thing to remember, they are not just done on a large, on the corporate level. They're done on the unit level, on the division level, on the department level. So this is this process, this multi-step process, highly disaggregated, decentralized process that then overall is centralized into one large corporate budget. But the key point is, I think the key goal of budgeting is aggregation of knowledge. That's the most important thing, aggregation of information. You can think about, I think it brings up a nice notion of what is the role of the CEO, right, of the company. Like what makes a good CEO, or the key function of the CEO, right? A CEO, a large multinational, by definition, cannot be in every part of the business. Their goal is to direct overall strategy of the company and, kind of direct the big ship, right? So, they can't suffer from information overload. They need good level, high level aggregated information. And in some ways it is, that's what, budgeting accomplishes that role. It gives them that aggregated high level data to direct this big corporate ship so that they can make high level decisions. And that's what fundamentally the role of the CEO is, of the high level executive, is that they work fundamentally with aggregated information. They need to know enough detail, right, about what drives the aggregate. But the budgeting process gives a sense of strategic direction. Gives them the big picture. So you can think of the analogy, if you're on a battlefield and you're a general, you don't look at what every soldier is doing, but you need a big map to know where all of the units are and where they're going and what is the big plan for moving armies. So in some ways, budgets play that role. So that's what the next slide is about. Making forecasts involves accumulating the collective knowledge of numerous individuals in the firm. So this is my idea of having multiple spreadsheets, and like figuratively speaking, and everybody sitting in front of their spreadsheet, and you aggregate it all together. No manager has detailed knowledge of total expected sales, but the individual salespeople have knowledge of likely unit sales in their district. So going back to my spreadsheet here, so for example, this information here on the expected demand could come from individual salespeople, right, that need to, maybe the company would have some sort of a survey that every salesperson needs to file. They aggregate this information with the expectations. There's a system of reporting what's going to happen next month, what do you think is going to happen in 2 months. That gets aggregated into the financing area, and they put it into their forecasted spreadsheets. From these key planning assumptions, a complete set of management plans is developed regarding the raw materials acquisition, labor requirements, financing plans, distribution, and marketing budget. So that's exactly, again, going back here, for instance, when we're talking about forecasting in the first part of the class, we didn't really spend a lot of time as to what were, those assumptions came from, right? I just picked numbers, sort of, right? And basically said, these are the numbers, right? Because we were focused on much more just how to physically create a forecast. But now, for example, what should the target balance in inventory be as a percentage of net sales? Right. Well, I picked 10% because I needed to pick a number, but why 10%, not why 5%? Well, maybe that's what will be based on in this internal knowledge in the organization is like, what do you want your inventory cushion to be? Right? How much, do you expect supply chain disruptions? If you do, you need to have a higher cushion. If you think everything runs nicely and smoothly, well, holding inventory is costly. It costs money to have warehousing space. Also, inventory gets obsolete over time. You have to hire people to do it. That's an internal business decision, what this number needs to be, and that's done by operation people. And operation supply chain people need to communicate that to management, to the financing side of things. And that's how it gets, factored in the budget. Same thing with, what do you want your accounts payable balance to be at the end of the period? Well, it depends on what do we want to do our cash cycle? How do we want to pay our bills? I mean, are we, do we have very high level needs to preserve cash? So we're going to try to squeeze as much as we can out of it, right? See if we can delay bill payments, or maybe we don't want to do that, for one reason or the other. Same, in particular one, the capital expenditures, that's more of a long-term strategic goal. And what are we going to build factories? Are going to buy more machinery because we think we're going to expand a lot because our product is in high demand? Well, we need to budget more for capital expenditures then. I mean, well, how do we want to grow? Or do we think that maybe on the opposite? Well, we think there's going to be a downturn, or maybe we see that the market is cooling towards our product, so we're going to budget less for capital expenditures and so on. So that's, thinking about budgeting gives much more meaning to these assumptions here. And finally, to reduce tendency of short-term budgets, many organizations prepare long-term budgets of 3 to 5 year duration alongside short-term budget. So long-term budget, as we will say in a minute, are much more for strategic purpose goals, right? In other words, nobody really knows truly what's going to happen in 5 years. In fact, people have done research more in the analyst forecast space. Analysts also provide long-term growth forecasts, going out 10 years. They're largely very inaccurate, sometimes more than others. But then one has to ask a question: what's the purpose of such long-term forecasts? God only knows what's going to happen in 10 years. And the forecast is just to focus. What's more important is not the final number, but you're thinking about where you want to end up. You don't want to just be focused on tomorrow. You need to think about where do you want to be in 2-3 years. And again, this budgeting process formalizes that thinking. It forces us to just collect information, take a step back, and say, okay, where are we going? What is our long-term strategy? Chances are those guesses will not be correct, but it's still very important to go through the process of thinking about it. Now, the short-term budgeting is much more of an immediate control tool, right? It's kind of like, all right, It's sort of the same thing with the weather forecasting. We know that the weather forecasting, just like any sort of forecasting, in the short term is much more accurate than in the long term. So, if you, in a month from now, you pretty much can go, if budget 1-2 months out is a pretty accurate representation of where you'll end up. So it's sort of like taking, giving yourself as much most current information as possible for control purposes, and getting a sense of where you're going. If there's any short-term immediate correction of the course that's needed, that's what short-term budget provide you for, right? You don't want to be entirely surprised. You want to look at immediate trends, and again, what's going out there in the market, what's going on with your product. Short-term budgeting allows for that more immediate input into your modeling and trying to understand where you are. And of course, because of that, it also allows you to more systematically adjust over time your long-term budgeting as well. So when Jerry talks about corporate budgeting being a communication device, it's the idea that there's multiple people that input information in the budget, but in the process of doing so, they all get to communicate to each other. Like, for instance, think about going back to my spreadsheet, right? So where would the pricing information come from? Well, pricing information comes from marketing people, from pricing department, right? What do they decide? Why do they decide to price what they are, right? So price this bottle of wine as $20 versus $35. What do they expect happens with demand? Now, when they give this information to budget people, they need to explain that, right? And somehow, especially if good notes are taken, and different organizations do it differently, in some sort of a figurative sense, we're all sitting in this huge conference room and we're all talking to each other about it. So other departments will hear it and then they'll say, okay, the marketing people expect the demand for our product to go up or down, and that's why they're pricing accordingly. And that leads to this positive information feedback loop where everybody just kind of sharing their knowledge and their data with each other as a result of going through the budgeting process. Again, it goes back to the notion that the process is more important than the result. So you can think of the information dissemination through two channels: through vertical, meaning either from upper management down to the individual departments or units or employees, and that's more of strategic goals that management sets, right? Where do we want our ship to go, right? Where should the armies move to? What's our long-term goal here as a company? And then it goes the other way as well, right? From the bottom up, from the people on this in the field that have the day-to-day touch with the operations. They also inform the upper management with respect to what really goes on. Are their goals realistic or not? What's really truly happening? And horizontal kind of transfer of information across different units, from marketing to sales, from sales to finance, from marketing to operations, supply chain, and so on. Budgeting process forces everybody to talk to each other in this virtual huge conference room, whatever. And I'm speaking figuratively right now. And somehow everyone becomes much more aware of what everyone else is doing, and it forces them to adjust what they do, to adjust their expectations, to adjust their actions, to bring it more in line with hopefully with the overall organizational goals here. Atkinson's textbook talks about budgeting process determining the planned level of most variable costs, right? That's just another way of saying, okay, we know, right, we have the existing capacity, we have the existing machines, factories, whatever. These are our sunk fixed costs. We now need to decide, what our variable costs are going to be. How much are we going to produce? What is going to be the demand? What are going to be our expected manufacturing costs? What's it going to do to our profitability? Now, what else, besides simply producing widgets, and what will be needed to produce bottles of wine? well, what do we need to do strategically in terms of, coming up with new products, grabbing extra market share? How much should we budget for R&D, advertising, employee training? What do we need, right, to expand, to do better, and so on? And also, of course, budgeting serves as a control by setting limits on what can be spent in each budget category. Atkinson points out that budgeting reflects how well unit managers understand the organization's goals. Right? Again, you have top management on top, right, disseminating this, goals and strategy. They could disseminate it through the budget process, right? Everybody now, because we disseminate the knowledge, also we can disseminate the goals, and people can relate much better to the goals. Now, as opposed to, it puts it in much more concrete terms for everybody, in terms of numbers, in terms of costs, rather than in some sort of more qualitative terms. I mean, most people relate to concrete numerical information a lot better, right? It gives them a concrete piece of information to latch on. And it also goes from the bottom up, right? If, upper management sets unrealistic goal in terms of strategy, well, through the budgeting process, the lower level managers and employees can communicate that, wait a minute, this is not realistic. We can't possibly do this. Nobody wants to buy this product. This product or this costs are unrealistically low, given what we see in terms of our competition and demand for products and so on. It's a tool to coordinate the many activities of the organization, as we said. By considering the interrelationships among operating activities, a budget helps anticipate potential problems and can serve as a tool to help provide solutions to those problems. So again, right, because everybody talks to each other in this virtual conference room, it allows them to say, okay, well, you want, to increase sales by 10%, but we have a bottleneck in the supply chain here. Our suppliers won't be ready for this, or we expect that, this product is not going to be in such high demand. What do we need to do for that? So it improves this conversation and brings everybody onto the same page. So budgeting involves forecasting the demand for 4 types of resources over different time periods. So first of all, flexible resources create variable cost, right? So that's just deciding, okay, am I going to produce 1,000 widgets or 2,000 widgets? And what sort of resources I need for which, right, for each category, right? So that's the easy part. That's just going back to my spreadsheet and saying, okay, this is a number here going to be 150,000 or should be 170,000, right? And if I change it, what's that going to be, right? How does that change the picture? Because I could immediately see the impact on the income statement, how it changes across different scenarios, and what's going to be for my cost. So maybe margin of 60% is too low. Maybe it should be 70%, right? What's that going to do, and so on, right? So they're just trying to understand the dynamic of different assumptions for the different levels of production or service providing. Then you need to think about capacity resources create fixed costs. So that's more about, what should be in here in my capital expenditures category, right? I'm expecting to grow sales by 30% every period. Well, how much do I need to add to my existing capacity? How many more factories do I need to build? Right? How much machinery will I buy? How am I going to buy it? How am I going to finance it? Am I going to generate enough cash to be able to buy it? What's it going to cost? And all of that, suddenly has to flow in this budgeting and planning exercise. Resources in intermediate long-term enhance the potential include R&D, employee training, maintenance of capacity resources, advertising, and promotion, right? So as these are all different categories that perhaps would go in here. And that's G&A, right? Obviously as G&A is a high-level summary category, but that's where your R&D, expected R&D expenses are going to go in. Your expected employee training is going to go in, right? Do you need to, if you're going to introduce new product lines and new technology, well, how much do you need to train your employees, right? What do you need to spend on recruiting? Are the type of employees you're going to hire going to change? I mean, can you do with the existing people? Do they have enough skills? Do you need to upskill them, right? Right now, for example, well, as of, I would say, last 6 months, many companies, for instance, PricewaterhouseCoopers, they were, which is a big four accounting firm, they were involved in a massive upskilling campaign, right? They were spending millions and millions of dollars on retraining their whole workforce to be much more digitally uh, literate, right? And that includes even basic programming for everybody, data analytics for everybody, because they see that the whole market is changing, the whole business model is changing, so they need to budget that in over a long period of time. How long will it take them? How much money it will take them? How many years it's going to affect? That all of that needs to go into the budgeting process. Long-term capacity resources created fixed costs, so that again kind of relates to the, I would say, the capital budgeting process. Maybe intermediate term capacity has to do with buying extra machines, and here you can think about building extra factories, or maybe buying other companies to add to your existing resources, and so on. So for that reason, budgeting has a strategic planning objective, especially in the long term. Process whereby managers select firms' overall objectives and tactics to achieve them. That gets quantified in the budget. What markets do we want to be in? What products we want to produce? What pricing strategies to choose? Thinking about all of that translates into the numbers that you saw in the assumptions to the forecasting worksheet. Long-term budgets are used for strategic planning purposes. Here you want to think about scenario analysis. Scenario analysis has to do essentially with going back to my spreadsheet and preparing multiple sets of this forecasts, right, under the different scenarios, and you just keep changing numbers in different ways and assumptions and see what it results in, like what project, what do the final forecasted financials look like in the end, and the different sets of assumptions, and then kind of develop a strategy on that basis. Capital budgeting, of course, forecasts have to go into the notion of how much capacity you need to add, and it forces to and for that reason, 5 to 10 year budget force managers to think strategically and communicate specialized knowledge. So fundamentally, objectives of budgeting are to align decision rights, to communicate and coordinate information both vertically and horizontally, set goals through negotiation, internal contracting, and measure performance. Align decision rights essentially has to do with, how do we communicate strategic goals of upper management to what the lower level management does, right? We need to be all on the same page. We talked a lot about the communication of information already. Goals for negotiation, internal contracting. We will learn in the chapter on. We learned in the chapter on transfer pricing that you need to. We're trying to essentially treat every profit center as sort of a separate unit that is evaluated separately, and so. How do we set up budgeting process in some ways informs how different units need to work together. And finally, performance measurement, which is something that people think about much more often because in context of budgeting, because you can use budget versus actual performance as a way to evaluate management. So in the end of the day, when we talk about how one develops a budget, financial budget, first you need an operational budget in the sense that you need to have a sales plan, a capital spending plan, a production plan, material purchasing plan, labor and hiring training plan, administrative discretionary spending plan. These are operational plans. Now, those operational plans you can think about, for example, sales plan, we'll talk about, how much demand we're going to sell, what are we going to sell, right? How many bottles of wine in any given market. Capital spending plan, we'll talk about how much property, plant, equipment you need to acquire. Production plan in some ways will be informed by the sales plan. Material purchasing, we'll talk about cost of sales, SG&A expenditures, and so on. So these are operational numbers. They're done by operational people, and then that information gets communicated to budgeting and finance people, and they put it in any quantifiable financial terms. Now, ultimately, what we see is this, budget is a statement of projected income statement, projected balance sheet, a statement of expected cash flows, which is what we have in our forecasted financial statements spreadsheet that you saw when we talked about forecasting, right? This is essentially sales, income statement budget, balance sheet budget, and there's your cash flows budget for that purpose. So Jerry talks about budgeting process in General Electric, for example, which he also has some discussion on Microsoft in the chapter. So each sprint, each profit center develops a 3 to 5 year plan describing the macroeconomic factors expected to affect supply and demand on each profit center, right? So that's from the bottom up, right? Each one of them, each profit center gets together, talks about what goes on with their market, and that's how they disseminate knowledge to each other. In the fall, all of the sprint forecasts are updated using the last 6 months of data, right? So in other words, it makes the budget a little more relevant and a little bit more real. Each profit center provides detailed operating budgets for its business for the next fiscal year to start the process for the next year, right? These updated forecasts and budgets are presented to GE board. So they are really doing it from the bottom up to try to inform the GE board about, or the executives about the long-term strategic lay of the land of where they expect it to end up. So this concludes the first part of the budgeting video. We'll see you again in the second part. Thank you for listening.